Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael Seiding. We are at the Cagr and conclusion part of the deep dive into FIX, Comfort Systems. And just to recapture again the P equals F times V method, which consists of fundamentals, valuations, a future price, adding in the dividends, and calculating a total annual return. And in terms of FIX, we concluded that they should be able to grow by at least 15% sales growth rate. They actually seem to be growing easily faster than that, but it's hard to tell. Of course, we never know exactly about the future. We don't really know why they were able to grow this quickly the last couple of years or few years, and whether, let's call it 2 to 3 times GDP level of growth rate, if that's reasonable for a company like this. But if they grow by 15% in terms of sales, they should easily be able to grow EPS by 18%. And if their recent return on equity numbers have been in the almost 40% range, and their average for like 10 years has been in around the 25% return on equity. Growing by 25% return on equity means a doubling every 3 years. So we're definitely dealing with a company that has high growth potential and a high growth history. Perhaps they are moving into a bit of a slower period now or not, or maybe they actually are about to accelerate. In order to actually establish which one is more likely, we would need more detailed information on management, on their porter situation. What are their suppliers doing? What are clients doing? What do we expect from the real estate industry? What kind of short-term effects can we expect from the tariffs war, or the end of the tariffs war, perhaps? In any case, what I'm trying to demonstrate today is that you don't always need a calculator to calculate total annual returns. Sometimes it becomes as easy as this example I've prepared here for FIX. So we have a certain growth rate for the fundamental variable F. In our case, it's 18% annual EPS growth. And then we turn to the valuation variable V. I think that a plausible estimate here is that since apparently the market is a bit skeptical as to the company's ability to grow this profitably, because if the market actually took all these numbers to heart, then FIX could be it could be twice the price of compared to now, and still be pretty okay. Just look at the software sector and other established high growth companies. They typically get a much higher than 27 times earnings PE rating. So I would say that they will at least keep their forward earnings estimate multiple. So it's currently at 23 times the next 12 months earnings. I'm trying to emphasize this very carefully, because you can use the P equals F times V. You can use it for any type of multiple you like, and you can use it for any timing multiple and earnings or fundamental variable you want. And in this case, I'm basing my estimate for the future price and the total annual returns. I'm basing it on future multiples, and right now it's at 23 times the estimate of coming earnings, and I'm expecting it in 4 years' time to still be at 23 times at the time then future earnings estimate. So what I'm going to do now is take next year's earnings estimate, which we're not quite certain what level it will be, but we'll simply use our own calculation of next year's earnings, or the market consensus estimate for next year's earnings. And then I'll extrapolate that by 18% per year to come up with an earnings estimate 4 years into the future. And it's actually 5 years into the future. But what I'm talking about is that I move myself from today 4 years into the future, and I keep looking at the earnings estimate at the time that is 12 months even further into the future. And then I'm using the multiple I want to use. I've already said that today I'm using a 23 times multiple of that earnings, and 4 years into the future I'm still looking 1 year ahead and using the 23 times PE multiple. So what I'm actually saying is that I'm expecting the fundamental variable, whichever one I'm looking at, but in this time, right now I'm looking at the earnings per share. I'm expecting it to grow by 18% per year. And I'm also saying that I'm expecting zero re-rating, zero change in the multiple. So I'm expecting it to go from 23 to 23, so there is no annual change whatsoever in the actual valuation multiple. And I think this is a pretty good way to get a very quick estimate of my total annual returns. And when it comes to this company, Fix, it seems as if the market is not really ready to award it a very high multiple. It seems the market over time has rather taken a backseat in terms of valuation multiples, and just let time do the work, and you'll simply get the fundamental growth. That is what you get in terms of total returns. Well, there has been a little bit of a re-rating, as we saw in terms of EV to sales, or price to sales, going from 1 to 2. So it has been a re-rating, but that actually is explained by margins doubling over that time. So the price earnings ratio hasn't moved that much. So you get an 18% EPS growth rate, a 0% re-rating, and the dividend yield is actually less than 0.5% per year, so you can almost just disregard it. Anyway, the total return Cagr will simply be the sum of these. And so you get 18 plus 0 plus 0.5. Well, maybe you should just discount the dividend ratio, because we have a couple of percentage points uncertainty, actually even more in terms of EPS growth rate. But in total, this means that we can expect an 18.5% total annual return. Pretty good, but is it good enough? What is the risk of missing the estimate here in terms of 18% EPS growth? Well, I would say that the risk level is lower than the market average. Even though this is a construction-related company, it also has an element of improvement and maintenance and stuff that improves the underlying industries. It improves the business of their clients, rather than being directly exposed to the cyclicality of it. It also has a very high return on equity and return on assets, which means this is a very stable company. They will not face bankruptcy or anything like that. And they seem to have a good management, otherwise they wouldn't be able to produce these kinds of numbers. So I would give it a 10% lower risk score than the market, so maybe 13.5% rather than 15%. This gives us a risk-return ratio that is 37% better than for the market. So this is the risk-reward ratio is one potential key indicator to track. However, we can see that analysts on average, they are not as sanguine. So there's something that they are a little bit afraid of, and I would say that is why we get this opportunity to buy Fix at a level that I consider actually pretty cheap.